Chapter 5, we're going to be discussing merchandising operations. And up to this point, we've been dealing with Smart Touch learning, which was predominantly a service operation. Our first learning objective, or in our first module of Chapter 5, we're going to go through a basic description and an overview of merchandising operations. Businesses, of course, will sell either goods and services, but when a business sells inventory or goods, we call them a merchandiser. And although most of the operating cycle of any business can be similar, in the merchandising business, it has a special type of process, and it's unique in that it involves the receivables, payables, and inventory. So when we looked at this cycle, or the cash operating cycle, in an earlier chapter or an earlier module, we thought about the links. And remember, when we think about those links in the operating cycle, we have cash that's used to buy inventory. And in fact, we could also use trade payable or trade accounts payable to finance the inventory acquisition. Then we sell the inventory and collect cash. So the critical links in the operating cycle are going to be the use of either cash or trade accounts payable to acquire inventory. Then we sell the inventory and we have to wait for cash. At any point, and I think these are the critical links in that cash operating cycle, because at those 2 points, if inventory cannot be sold, it becomes obsolete and you have a cash shortage. Even if you sell the inventory, but if you can't collect, you have a cash deficiency. So this cycle is critical because the seller of goods, whether a wholesaler or retailer, has to be able to manage both inventory and accounts receivable. The supply chain, getting the inventory in when you need it, and making sure that you could deliver it on a timely basis is critical so that you're not holding inventory for too long. If you hold up inventory and you hold it for an extended period, your cash is being tied up, or you're going to owe somebody money very shortly and you don't have the cash to pay. So if inventory is not sold, you have cash tied up in inventory, and then when it's sold, you have to manage accounts receivable in order to be sure that it's collected on a timely basis so that you have enough cash to pay off those trade payables. So holding too much inventory ties up cash and stalls the cash cycle. Unable to collect receivables results in not collecting enough cash and also stalls the operating cycle. Now, again, inventory management and receivable management are critical to success. Now, a wholesaler, just to differentiate, will sell merchandise to a retailer. So there are many, many companies that you don't hear about because they sell their goods to another company for sale. They don't have their own stores. Sometimes, of course, it's very easy to find a brand on a shirt. You know, you might have a tag on the back of a shirt. It might be, a brand name. It could be, a particular type of shirt that is very popular, but it's only sold in a certain store. Well, that manufacturer does not have their own stores. So one company that, you might think of is Dell. Dell is pretty much wholesale when it sells to other businesses. It becomes a retailer when it sells to the customer. Sells to the final customer. So you could be both a wholesaler and a retailer. You wholesale when you sell to other businesses. You're a retailer when you sell direct. Most companies do both. So, for example, take Hewlett-Packard or HP. If they're selling printers, typically you don't buy the printer directly from Hewlett-Packard, but you could. If you go on their website, you could probably buy directly from the website. Other companies may not sell directly to the customer, and you can only buy them through an authorized retailer. Now, again, when a business acquires inventory for resale, it becomes a merchandiser. It either plans on selling the inventory as is, but with a premium added is a markup, or it's a gross profit. So obviously, you're not going to sell the inventory at cost. More likely, there's going to be a difference between the selling price and the cost. And the difference between the selling price and the cost is called the gross profit. So we generally mark up the cost of the inventory and resell it for a higher price. Inventory could be purchased, as we said when we looked at the cycle, for cash or on account or accounts payable. If it's purchased on a trade accounts payable, you take possession now, sell it, and then when the cash arrives, you'd be able to pay off that payable. And of course, when you acquire inventory with accounts payable, of course, that becomes the trade or accounts payable account, and it is a current liability. Now, that is something that you would typically see where a company would use accounts payable almost exclusively for their inventory purchases. Now, merchandising operations have significant or pose significant issues for us with respect to looking at accounting in an early stage, because merchandising operations will modify the financial statements quite a bit. So the income statement differences. So if we look at this first issue, when we think about the income statement differences, versus a service provider, if you're selling merchandise, you now have sales or sales revenue. Before, with Smart Touch, you were consulting, you'd have service revenue. And then on the income statement, your expenses will have two categories. The cost of goods sold, that represents the amount you paid for each unit that you sell, and operating expenses, which are your selling, general, and administrative expenses. When you look at the income statement again, to summarize, sales versus, as I said, service revenue. And of course, your cost of goods sold, which is the cost of the units that you buy. So, for example, if your sales revenue is $1,000, let's say you're selling a laptop computer from Hewlett-Packard in, let's say, a Best Buy or a retail store, the cost of that computer cost of goods sold could be $700, and the difference is their gross profit, the $300. So cost of goods sold is what you pay the manufacturer for the products that you're going to be selling. And that gross profit is a key statistic for a merchandising company. Gross profit is the amount of sales revenue that is available to cover your operating expenses and contribute to your overall profitability. Gross profit, as I just mentioned, is the difference between sales revenue and cost of goods sold. So again, very simply, if you sell a product for $5,000, but it costs you $3,000 to acquire it from the manufacturer, your gross profit is $2,000. And that $2,000 is now available to cover your operating expenses. And once you deduct your operating expenses, that's when your net income or your net loss is determined. Now, we're going to look at an income statement just to compare it with a service business. And what we've seen so far was nothing but a service business. So the key differences are going to be on the income statement is the sales revenue, but even more importantly is the cost of goods sold. So when we look at the merchandising financial statements, you'll notice that the income statement is first. And once again, the name of the company, the statement, and for the year ended is your income statement. Notice rather than having service revenue, you have sales revenue, and then you have your cost of goods sold. Sales minus cost of goods sold is gross profit, and then we subtract out our operating expenses to get our net income. So the gross profit is going to contribute toward covering these operating expenses and contribute to the overall profitability of the company. Remember that if you cannot sell a product with a very high gross profit or a strong gross profit, you may not be able to cover these expenses and you're going to incur operating losses. So the income statement for the merchandiser differs from the service company because of cost of goods sold and, of course, the gross profit. These are two key metrics that we tend to look at. A company is going to survive if it could produce a very positive gross profit. In other words, if it could keep selling at a very high margin over its cost. Companies and financial analysts will follow companies, and they'll look at the trend of gross profit over time, and they'll look at their trend in cost of goods sold over time. A deterioration in gross profit or a spike in the cost of goods sold could cause businesses to fail. So if there is a unexpected increase in cost and the market could be very sensitive, you could be a price taker where you cannot set the price because of, let's say, technology and prices keep dropping. You can't raise your price to recover if costs go up. If your gross profit goes down, you may not be able to cover these operating expenses. So one of the key differences is the income statement, and that metric, gross profit or cost of goods sold and gross profit, are critical to monitor, and it's a key statistic for financial analysts. If you think about the relative magnitude for cost of goods sold, it's probably one of the largest expenses on a merchandising operations income statement. It's very material, it's extremely significant. And of course, the idea that gross profit is sales minus cost of goods sold was already expressed. I just want to remind you that we're going to get back to this, the notion of net sales. Why do we have net sales there? We'll explain that. But very briefly, I can tell you that net sales means that in some cases, discounts are offered and allowances or sales returns reduce the amount of sales. Next, balance sheet. So we just looked at the income statement difference. Next, we want to look at the balance sheet differences. What are the key differences in a balance sheet of a merchandising company versus that of a service entity? And the primary difference is that a merchandising company will carry merchandise inventory as one of its principal assets on the balance sheet. When we looked at Smart Touch Learning, the only inventory they really carried was an inventory of supplies, which was not very significant. It was about $500, and it is very, very insignificant relative to the amount of inventory that a merchandising company will carry. And of course, the merchandise inventory is not only significant, but it is a current asset on the company's balance sheet. Again, remember, because of the materiality, the significance of this account, you have to be able to manage inventory. You have to manage your supply chain very, very carefully to ensure that cash is not tied up, it's not stalled, where you don't have enough cash coming in. If you can't sell the inventory, it's obsolete. If you can't sell the inventory, you have to mark it down. Markdowns will reduce profit. The merchandising company's balance sheet will appear the way we see it here. And this is a partial balance sheet. And again, the name of the company, balance sheet at, so it's a position statement. And of course, merchandise inventory is a significant current asset. Once again, listed in the order of liquidity. And of course, merchandise inventory is the only inventory we list here because this is a merchandising company. In a manufacturing company, you'll have not only merchandise or final produced items or finished goods, you'd have your raw materials you need in production and your partially completed goods work in process. So for a merchandising company, you only have merchandise inventory. For a manufacturing company, you'd have raw materials, work in process, and finished goods. So for a merchandising company, there's only one type of inventory. And of course, accounts payable, which is important, and I'll get back to this inventory in a second, which is an important liability for a merchandiser, would be the key way in which we acquire inventory, where we have open or trade credit. So you would expect that accounts payable would be significantly higher when you deal with a merchandising company. Now, on the whiteboard, what I wanted to differentiate, and the last point we want to make, with a merchandising company versus manufacturing. You usually have one type of inventory here. But for a manufacturing entity, you have three types of inventory. You have raw materials, which are the components into the manufacturing process. You have work in process. And again, these are inventories. And the third is the finished goods inventory. So let's say that you're manufacturing laptop computers. You would pack it, for example. Raw materials inventory would contain computer chips. Work in process is partially completed inventory. So at the end of the year, you may still have some inventory in process. And of course, finished goods inventory are completed. Now, if the company, HP, or any manufacturer of laptops is wholesaling, they're going to sell this inventory to a merchandising company. Let's say it's going to be a Best Buy, and that merchandising company, when they get the finished goods from the manufacturer, they would call it merchandise inventory. So merchandise inventory is basically the finished goods in the hands of the merchandising company. So the manufacturer has raw materials, computer chips, etc. The partially completed inventory is called work in process inventory. And the finished goods inventory would represent the completed products. Those completed products, when sold to the merchandising company, and this would be a way of wholesaling. And then, of course, we'd sell it here to the final customer. And that would be a retail operation. All right, so first module, just a very brief description of merchandising operations. In Module 2, or Learning Objective 2, we're going to determine how to account for the purchase of merchandise inventory under a perpetual inventory system. We'll also differentiate the two types of systems, periodic versus perpetual inventory systems.